All right, so investing. It can feel a bit like navigating a maze sometimes, right?
Yeah, for sure. I think we've all felt that, haven't we? The uncertainty about whether we're making the right moves.
Exactly. Like, are we falling into those classic traps that even like seasoned investors can stumble into?
Absolutely.
So we're tackling a giant today. We're going deep into Benjamin Graham's The Intelligent Investor.
The Bible of value investing, as they say.
And we're going to try to pull out those core principles that can make us all, well, smarter investors, wherever we are on our investing journey.
It's a journey, for sure. And the thing is, Graham's insights, they still hold up surprisingly well. I mean, even after all these decades,
Right.
it's not about chasing the latest fads, or falling for those get-rich-quick schemes.
Yeah,
It's about building a framework for making sound financial decisions.
that's exactly why I wanted to do this deep dive. So easy to get caught up in the excitement of the market.
Oh, for sure.
But Graham, he's all about taking a step back, focusing on the fundamentals.
Absolutely. And, one of the most fundamental concepts he introduces is this distinction between investing and speculating.
Okay, yeah. Let's break that down. I mean, we hear these terms all the time,
Yeah.
but what's the real difference?
Well, for Graham, investing is about acquiring assets with the intention of holding them long term.
Wrong
It's
hat.
about thorough research and a deep understanding of the underlying value of a business. Speculation, on the other hand, is more about trying to, profit from those short-term market swings,
Gotcha.
often with less emphasis on careful analysis.
So choosing a stock because you believe in the company's growth potential versus like jumping on something because it's the hot tip of the day.
Exactly. It's a great way to put it. It's like investing is like planting a tree
Right.
and nurturing it over time, knowing that it will eventually bear fruit.
Okay.
Speculation is more like trying to catch lightning in a bottle. It might work out, in the short term, but
Riskier.
much riskier. Yeah.
Yeah, I like that. That's a powerful image. And I think it really does emphasize that having the right mindset, like from the very beginning, is key.
It is.
But honestly, it's so easy to get swept up
Right.
in that frenzy of the market.
It is.
So how does Graham help us avoid those emotional pitfalls?
Well, this is where one of Graham's most brilliant concepts comes in. Mr. Market.
Ah, Mr. Market.
Yeah.
I've heard the term, but I'm still a little fuzzy on who exactly this mysterious Mr. Market is.
So Mr. Market is basically Graham's way of personifying the stock market.
Okay.
He's this fickle character who shows up at your door every day offering to buy or sell shares at different prices.
So he's like the ultimate deal maker, always tempting us, right? With opportunities, whether they're real or not.
Exactly. But here's the thing. Mr. Market is driven by emotions, and often pretty rational ones at that.
Right.
His prices are all over the place, influenced by fear, greed, you name it.
Yeah.
All these psychological factors that can totally distort the true value of a business.
So he might offer us a ridiculously low price for a stock one day, make us panic and sell, and then turn around and offer us a crazy high price the next day, tempting us to buy back in at a loss.
Exactly. And that's why Graham warns us, not to take Mr. Market's offers too seriously.
Okay, yeah.
We shouldn't let his mood swings dictate our investment decisions.
So how do we resist those emotional pulls? How do we not fall prey to Mr. Market's, manipulations?
Well, Graham, he urges us to focus on the underlying value of the businesses we invest in, what he calls intrinsic value.
Anyway,
And it's a concept we're going to be diving into more deeply later, but the idea is to look beyond the market's short-term noise and really assess the true worth of a company based on its fundamentals.
so we're not just looking at the stock price, we're digging deeper into the company's financials, their management team, their competitive landscape, all those things that contribute to its long-term value.
Exactly. We're taking a more analytical approach rather than letting our emotions or Mr. Market's antics drive our decisions.
Makes sense. But I'm guessing that evaluating intrinsic value can be pretty complex.
Right.
Are there any specific tools or strategies that Graham recommends?
He does. He gives us this concept called margin of safety, which is kind of like a financial cushion to protect us from potential losses.
Okay, I'm intrigued. Tell me more about this margin of safety.
All right, so think of it this way. Let's say you're looking at a company and you figure out its intrinsic value is, let's say, $100 per share.
Right.
The margin of safety principle suggests that you shouldn't buy the stock unless it's trading at a significant discount to that value, maybe $70 or $80 a share.
So we're essentially building in a buffer,
Yeah.
right? The safety net, just in case our valuation's a little off or, the market takes a sudden downturn.
Exactly. By buying below intrinsic value, we're creating this cushion that helps mitigate risk and protect our capital.
Like buying something on sale.
Right.
We're
Isn't
getting more value for our money,
Yeah.
and we're less likely to feel the sting if the price drops further.
That's a great analogy. The margin of safety is all about minimizing those potential downsides while still allowing for, the possibility of some significant upside potential.
Okay, this is starting to click. But I'm wondering, does Graham acknowledge that not everyone has the same risk tolerance or the same amount of time to devote to researching companies?
Oh, absolutely. He lays out two distinct investor profiles in the book: the defensive investor and the enterprising investor.
Okay, I'm all ears. Let's dive into these investor personalities. Tell me about the defensive investor.
Okay, so the defensive investor, as the name suggests, is all about minimizing risk and preserving capital.
Right.
This investor might have a lower risk tolerance, maybe because of their age, their financial situation,
Right.
or maybe they just prefer a more hands-off approach.
So they're not necessarily looking for the absolute highest returns, but they want to sleep well at night knowing their investments are, relatively safe.
Exactly. They prioritize stability and consistency over chasing those big risky gains.
And what kind of investment strategy would Graham recommend for a defensive investor?
Well, he suggests a diversified portfolio with a good allocation to high-quality bonds.
Okay.
Bonds, as we'll talk about a little later, tend to be less volatile than stocks, and they can provide a steady stream of income.
Gotcha.
He also recommends investing in well-established, blue chip companies with a proven track record of profitability and dividend payments.
That makes sense. It's a more conservative approach, but it can still, generate decent returns over the long term. So what about the enterprising investor? Are they more of the risk taker?
Yeah, you could say that. The enterprising investor is willing to put in more time and effort to potentially uncover those undervalued gems, the ones that the market has overlooked.
So they're more actively involved in, researching companies, analyzing their financials, making those investment decisions.
Precisely. They're comfortable with a higher level of risk and willing to put in the legwork to, maybe reap greater rewards.
Yeah.
Graham suggests that enterprising investors focus on value investing, which is, all about identifying those companies that are trading below their intrinsic value.
Okay, so I'm starting to see how these two profiles, they differ in their approach and their risk appetite. But I'm curious, which style resonates more with you? And what about our listeners out there? Which camp do you all fall into?
That's a great question. I mean, it really depends on your individual circumstances, right?
Yeah.
Your financial goals and your comfort level with risk.
Right.
There's no right or wrong answer. You might even find yourself somewhere in between these two profiles.
Absolutely. The key is to understand your own investing style and develop a strategy that aligns with your individual needs, your preferences.
And that's where Graham's guidance is so valuable. He gives us the tools and the insights we need to make those informed decisions.
Speaking of tools, I'm curious about, the criteria Graham uses to evaluate companies. What are some of those key things he looks for when deciding whether to invest in a stock?
That's a great question. And it brings us to one of the most practical and actionable parts of Graham's approach, actually. He gives us a set of specific criteria for evaluating companies. We can think of it as a checklist
Yep.
to help guide our investment decision.
Okay, let's dive into that checklist. What's the first item on Graham's list?
He starts with financial strength, which to him is like the foundation of a sound investment. He emphasizes looking at a company's balance sheet, which is like a snapshot of their financial health at a specific point in time.
So we're looking for companies with strong balance sheets, meaning?
Meaning they have low debt, ample cash reserves, and a healthy ratio of assets to liabilities. Think of it like this. A company with a strong balance sheet is like a sturdy house.
What?
Built on a solid foundation, right?
Yeah.
It can weather those economic storms
Yeah.
and keep growing over the long term.
That's a helpful analogy. So a strong balance sheet is like a sign of stability, resilience.
Exactly. It suggests that the company is managing its finances responsibly and has the resources to deal with challenges, pursue those growth opportunities.
Okay, financial strength check. What's next on Graham's checklist?
He also looks for companies with consistent earnings. He wants to see a track record of profitability at least 10 years, showing the company's ability to make consistent profits, regardless of those market ups and downs.
So not just a one-hit wonder, but a company that's consistently performing.
Precisely. He wants to see a pattern of steady or growing earnings, which indicates that the company has a sustainable business model,
Gotcha.
that it can weather those economic cycles.
That makes a lot of sense. Consistency is key, especially when we're talking long-term investments. What else is on Graham's checklist?
He also pays attention to dividend records. Companies that consistently pay dividends to their shareholders, that signals that they're financially healthy. They want to return value to those investors.
Okay, dividend records noted. Anything else?
Yes, he likes moderate price ratios. These are metrics that help us figure out whether a stock is overpriced or undervalued relative to their earnings, assets, or other financial metrics.
Can you give me an example of a price ratio that Graham uses?
Sure. One of the most common ones he uses is the price to earnings ratio, or PE ratio. It basically tells you how much investors are willing to pay for each dollar of earnings that the company generates.
So a lower PE ratio might suggest that the stock is undervalued.
It could. It means that investors are paying less for each dollar of earnings, which could be a sign of a good value opportunity.
Okay.
Of course, it's important to look at other factors too, but Graham sees moderate price ratios as a positive sign.
This reminds me of that company we saw in the news a while back. Their PE ratio was through the roof, and then bam, their stock took a nosedive. Seems like Graham was onto something.
He definitely had a knack for spotting value. And all these factors we've talked about: financial strength, consistent earnings, dividend records, moderate price ratios, they all ultimately lead us to one of the most fundamental concepts in Graham's approach: intrinsic value.
Okay, time to unlock the mystery of intrinsic value. What's the secret code?
All right, so intrinsic value, think of it as the true worth of a company. Okay. It doesn't matter what the market might say.
Okay.
It's based on its assets, its earnings power, its future prospects.
So it's like that antique you found at a flea market.
Oh, yeah.
It's worth way more than the price tag, even if no one else sees it.
Exactly. Graham believed that the market often misprices assets,
Okay.
and that creates opportunities for those intelligent investors to buy undervalued companies and profit from, their eventual recognition by the market.
So we're trying to look beyond the noise, the hype of the market, assess the real value of a company based on its fundamentals.
Precisely. We're not just looking at the stock price. We're digging deeper into those financials, the management team, the competitive landscape, all those things that contribute to its long-term value.
Okay, I think I see the intelligent investor mindset coming into focus here.
Exactly. It's about discipline, rationality, and taking that long-term perspective.
Of course, resisting those emotional pulls, right? The ones that can lead us astray.
Yeah, absolutely. Graham encourages us to, be skeptical of those market predictions and avoid just blindly following the crowd. He wants us to think for ourselves,
Yeah.
do our own research, make informed decisions based on our own assessment of value.
This makes me wonder, how can I cultivate more of an intelligent investor mindset
Hmm.
in my own financial decisions? What about you, listener? What are you thinking?
That's a great question to reflect on.
Yeah.
And it's definitely something we'll keep exploring as we go deeper into Graham's wisdom.
Stay tuned, folks. We're just getting started on this journey, unlocking the secrets of the intelligent investor.
So we've talked a lot about stocks, but I know Graham also puts a lot of emphasis on bonds, for a well-balanced portfolio. I gotta be honest, though, bonds always seemed kind of mysterious to me.
How so?
Like, why invest in something that's, known for slower growth compared to stocks anyway?
Well, that's a common misconception, actually, but bonds are super important for managing risk. They provide stability to a portfolio.
Okay, yeah.
So while they might not have that, explosive growth potential of stocks, they do offer a level of predictability, security,
Right.
especially when the market gets a little,
Oh.
turbulent.
Okay, so like a safety net in case the stock market takes a dive.
Exactly. Think of them as the ballast in a ship,
Okay.
keeping it steady during rough seas. When stocks are going up and down, bonds are usually more stable. Kind of a counterbalance to smooth out the overall performance of your portfolio. I see. But bonds come in so many different forms, don't they? Government bonds, corporate bonds, municipal bonds. How do we even, start to make sense of all that?
Yeah, the bond market can seem pretty complex, but Graham gives us some, guiding principles to help us make sense of it all.
Okay, good.
First off, he stresses the importance of credit quality.
Okay, credit quality. What exactly does that mean when we're talking about bonds?
It's all about the issuer's ability to repay the debt. The higher the credit quality, the lower the risk of default. So, for example, bonds issued by the US government, they're generally considered to have the highest credit quality, right?
Right.
Because the government has a good track record of paying its debts.
So for those of us looking for lower risk bonds, we should probably stick with ones issued by governments or like highly rated corporations.
Yeah, that's a good rule of thumb. Graham also talks about maturity dates,
Okay.
which is basically the date when the bond issuer has to pay back that principal amount.
So a bond with a shorter maturity date, would that be less risky than one with a longer maturity date?
Generally speaking, yes. With shorter term bonds, your money's tied up for a shorter time, which reduces the risk of things, changing, like interest rates going up.
Okay, maturity dates, got it.
Yeah.
But how do we decide like the right mix? Stocks and bonds in our portfolios. Is there a magic formula?
No magic formula, unfortunately.
Darn.
But Graham does offer some general guidance. It depends on your risk tolerance and your time horizon. So he suggests that younger investors, they have more time, right?
Right.
They can handle more risk, so maybe they allocate a bigger chunk of their portfolio to stocks.
Yeah, makes sense. More time to recover from those market drops. What about someone closer to retirement, though?
Well, as you get closer to retirement, your time horizon gets shorter. You might want to shift to a more conservative approach.
Okay.
Maybe increase your allocation to bonds to protect your capital and generate some steady income.
So it's about finding that balance, risk, and return based on, our individual situation.
Exactly. And always remember, diversification is key.
Okay. Yeah.
By spreading your investments across different asset classes, like stocks and bonds, you can reduce the overall volatility and potentially even improve your long-term returns.
This is super helpful. I feel like I'm finally understanding the role that bonds play, in a good investment strategy.
Yeah, they're often overlooked, but they're super important for managing risk and building a more resilient portfolio.
Okay, bonds, demystified.
Mhm.
Now, I want to circle back to Graham's signature strategy, value investing.
Okay, sure.
We touched on it earlier, but I'd love to dig in a bit deeper. What are the key ideas behind this approach?
Value investing, at its heart, it's about buying assets for less than they're actually worth.
Gotcha.
It's finding those hidden gems, the undervalued companies the market has missed.
So kind of like being a treasure hunter.
Exactly. Requires patience, research, and the ability to see value where others don't. Remember, Graham believed that markets can be inefficient, meaning prices don't always reflect what a company is really worth.
So there are opportunities to kind of capitalize on those moments when Mr. Market makes a mistake, so to speak.
Exactly. And those value investors, like those smart antique shoppers we talked about, they can spot those opportunities and potentially reap the rewards.
This reminds me of one time I found this amazing vintage record player at a flea market. It was tucked away and no one else seemed to realize what it was. Got it for a steal.
Nice.
Turned out to be a real gem.
That's a perfect example. It's about doing your homework, understanding what something's really worth, and then having the patience to wait for the market to catch up.
Okay, so patience is a big theme here. It's not about those quick profits, but playing the long game.
Absolutely. Graham always said that investing is a marathon, not a sprint. It's about building wealth gradually, not trying to get rich quick.
So resist the urge to, jump on those hot stocks or chase the latest trends that might fizzle out.
Exactly. Stick to your principles.
Okay.
Focus on value and be patient.
Makes sense, but I gotta say, it can be tough to stay disciplined, especially when the market's going crazy.
For sure, it can be.
What are some practical tips for keeping that intelligent investor mindset, when things get emotional?
That's a great question, and Graham actually addresses it in his book. One of his key recommendations is to create an investment plan and then stick to it, no matter what the market's doing.
Okay, so have a plan. What else? How else can we stay grounded, avoid making those impulsive decisions?
He also suggests diversifying your portfolio,
Right.
which we talked about before. Spread your investments, different asset classes, different industries.
So don't put all your eggs in one basket.
Exactly. Even if it seems like the most attractive basket at the time, diversification helps smooth out those market ups and downs, and it can protect you from those big catastrophic losses.
Makes sense. Anything else?
Graham also emphasizes tuning out the noise.
The noise.
Yeah, the financial media, they bombard us with information, predictions, opinions all the time, right?
Right.
And it can be hard to stay focused on those long-term goals.
So be careful about the information we consume. Don't get swept away by those daily headlines.
Exactly. Focus on the fundamentals.
Okay.
Stick to your plan. And remember, investing is a long game.
This is all really great advice. I'm starting to get a much better grasp on, what it takes to be a successful investor.
I'm glad to hear that.
But I got to ask, does Graham have any specific advice about, managing risk? Because investing always involves some risk, right? No matter how careful we are.
He does. Risk management is actually a central theme throughout The Intelligent Investor. One of his big principles is to avoid overpaying for assets.
Okay, so back to intrinsic value, making sure we're not paying more than something's really worth.
Exactly. By paying a reasonable price, we create that margin of safety,
Right, that buffer.
which protects us from those potential losses.
So even if we're wrong about a company or the market does something unexpected, we're less likely to, get hit too hard.
Precisely. The margin of safety is like a financial cushion
Okay.
to protect us from the bumps in the road.
This is making a lot of sense. But what happens if we mess up? What if we misjudge a company or, the market takes a turn we didn't expect? Does Graham give us any advice on how to handle those situations?
He does. He knows that mistakes are going to happen in investing,
Yeah.
and he encourages us to, learn from them.
Okay.
One of his key pieces of advice is don't let losses turn into bigger losses.
Okay, so cut our losses when we need to, but how do we know, when it's time to sell?
That's a tough one. No easy answer. But Graham suggests revisiting your investment thesis, from time to time.
Okay.
If the reasons you bought the stock aren't valid anymore, or if the company's fundamentals have changed, then it might be time to think about selling.
So we're not just holding on to stocks blindly. We're keeping an eye on things and making adjustments when we need to.
Exactly. Investing is an ongoing process, not just a one-time event.
This is all super helpful. I feel like I'm starting to understand, the nuances of what it takes to be a successful investor.
Well, I'm glad to hear it.
And, Graham says that the most important factor in investing is often ourselves.
He does.
What do you mean by that?
He reminds us that our own emotions can be, our biggest obstacle.
Oh, yeah.
Fear and greed, they cloud our judgment. They lead to those impulsive decisions that can sabotage our long-term goals.
So self-awareness is key.
Yeah.
And emotional discipline. Those are the secret ingredients to becoming an intelligent investor.
Absolutely. It's about recognizing our own biases, understanding our risk tolerance, and sticking to our plan, even when the market's throwing us curveballs.
This makes sense, but are there specific strategies, techniques that Graham recommends
Like,
for managing our emotions, staying disciplined?
there are. One of his biggest pieces of advice is to focus on the long term.
Okay.
Remember, investing is a marathon,
Right.
not a sprint. Keep your eyes on that long-term horizon. Don't get caught up in those day-to-day swings of the market.
Right. So keep that long-term perspective, stay grounded when the market's going haywire.
Exactly. It helps you see the bigger picture. It reminds you that that short-term noise, it's just noise. It doesn't reflect the true value of your investments.
This is really helpful. I'm starting to understand those, the psychological aspects of investing.
Yeah, Graham got it. Investing is as much about managing our emotions as it is about, analyzing companies and markets.
And that's what makes the intelligent investor so timeless.
Yeah,
It gives us the practical tools and the psychological insights to navigate this whole complex world of investing.
absolutely. It's about giving ourselves the knowledge and the mindset to make good financial decisions and reach those long-term goals.
This has been a really insightful conversation. We've just scratched the surface, I think, but I already see how these principles can help me, make better, more informed investment decisions.
I'm glad to hear that. There's so much more to explore in The Intelligent Investor, but we've definitely hit some of the key points.
Yeah, so we've talked about, knowing the difference between investing and speculating, understanding how Mr. Market thinks, looking for that margin of safety, figuring out our own investing style, whether we're more defensive or enterprising.
Right.
We've also discussed the role of bonds in a diversified portfolio, those principles of value investing, and how important it is to manage risk and our own emotions.
Exactly.
It's a lot, but I feel like the pieces are starting to fit together.
They are. And remember, this is just the beginning of your journey. As an intelligent investor, that is.
Right.
There's always more to learn, more to explore, and more to discover.
Absolutely. So to our listener out there, think of this as a starting point.
Yeah, springboard.
Dive into the intelligent investor, go back to those concepts we've talked about today, and keep refining your own investing philosophy.
And don't be afraid to challenge those assumptions. Ask questions. Seek out new perspectives.
The world of investing is constantly changing, but, Graham's principles are a great foundation
For sure, they can help you navigate the complexities.
and reach those financial goals.
Exactly. And by always learning and adapting, you can truly become an intelligent investor.
Capable of making those sound decisions.
Sound decisions
Yeah.
and creating a more prosperous future for yourself and for generations to come.
Those are inspiring words. Thank you for joining us for this deep dive into the wisdom of Benjamin Graham.
It's been my pleasure.
And to our listener out there, this is just the tip of the iceberg. There's so much more to discover in The Intelligent Investor.
Definitely.
We encourage you to keep exploring.
As we wrap up this deep dive into The Intelligent Investor, I keep thinking about how Graham wrote this book like in a totally different world.
Oh, absolutely. Things have changed so much since then. I mean, the internet, global markets, tech disruption, all stuff Graham couldn't have predicted. So do his principles still, hold up?
That's the question, isn't it? I think even though the specifics of the market have shifted, those core principles of good investing, they're still relevant. Value investing, margin of safety, emotional discipline, just as crucial today.
Okay, so the fundamentals are still there. But how do we apply his ideas to, today's world? It's way more complex now.
Right.
Like Graham talks a lot about, analyzing financial statements, valuing companies based on their tangible assets. But what about, digital companies where things like intellectual property, brand value, those are huge factors.
Yeah, that's a really good point. I think how we value companies today, it might need to change. Take into account those intangible factors. Like we might need to look beyond, traditional metrics like book value and start considering things like network effects, data, the speed of innovation.
So kind of expanding that toolkit that Graham gave us, adding
Yeah.
some new tools to assess the value of companies in this digital age.
Exactly. Building on his foundation, but adapting
Yeah.
to those unique challenges.
This reminds me of another thing. When Graham wrote The Intelligent Investor, information was like a scarce resource.
It was.
Investors relied on printed reports, company visits, word of mouth.
Right.
Today, we're drowning in information, news, analysis, opinions everywhere. How do we sift through all that, make sense of it? Isn't there a risk of information overload?
Oh, big time. It's easy to get overwhelmed by the sheer amount of information out there.
Yeah.
But this is where that principle of independent thinking, something Graham really pushed, becomes even more important. We got to be like critical consumers of information.
Okay.
Evaluating our sources, questioning assumptions, coming to our own conclusions.
So it's not just about having access to information, but knowing how to process it, separating, the real stuff from the noise.
Exactly. And that's where having a good understanding of, financial principles like the ones Graham lays out can be so helpful. It gives us the tools to analyze information, make judgments, not get swept up in the hype or the, fear-mongering.
Makes me think about another challenge in today's market. Algorithmic trading, high-frequency trading.
Oh, yeah.
This leads to another thing I've been wondering. Graham wrote The Intelligent Investor for, individual investors,
Right.
people managing their own money. But today, so many people rely on financial advisors or they invest through mutual funds, ETFs. Does Graham's message, does it still apply to them?
It's a good question. Even if you're not picking individual stocks, knowing Graham's principles can make you a much savvier investor.
Okay.
You can evaluate different investment strategies, assess the risks and rewards, ask those tough questions of your advisor.
So it's about having a framework,
Yeah.
for thinking about investing, even if you're not the one making the day-to-day decisions.
Exactly. It's about being an active participant in your financial journey,
Yeah.
understanding those principles behind the decisions and having the confidence to make choices that fit your goals.
This has been a really thought-provoking conversation. We've dug into The Intelligent Investor and how those principles apply in today's market. What are some key takeaways you hope our listeners are getting from this?
Well, I hope they've realized how important it is to think for themselves.
Yeah.
To really look at the information out there and not just, follow the crowd or the so-called experts.
So embracing that independent, intelligent investor mindset,
Yeah.
like Graham talked about.
Exactly. And I hope they also have a better grasp on those core principles: value investing, margin of safety, managing risk, staying disciplined.
Those are like timeless lessons.
They are.
No matter how much experience you have or what the market's doing.
Absolutely. And I think it's crucial to remember that investing isn't just about, numbers. It's
Hmm.
about psychology too.
Yeah,
Understanding our own biases, making those rational decisions that help us reach our goals.
that's such an important point. Graham reminds us that our behavior, it can be our biggest strength or our biggest weakness as investors.
He does. And by, building that self-awareness, being patient, being disciplined, we can all become more intelligent investors.
It's capable of navigating those market complexities.
Exactly. And achieving lasting financial success.
This deep dive into the intelligent investor has been so insightful. Thank you for sharing your expertise and helping us unlock all this wisdom.
Happy to do it. And to our listener out there, remember, the journey of an intelligent investor, it's lifelong. Keep learning, stay curious.
Keep seeking those insights, right?
Absolutely.
Great advice. Well, folks, that's a wrap for this deep dive. We'll be back soon with another exploration of a fascinating topic. Until then, keep those minds sharp and those portfolios balanced.